The insurance industry overall has tangled with the low interest rate environment for the past decade. But it's been a bit of a thornier issue for the life annuity sector, especially amid the economic impact of the COVID-19 pandemic. A new report from AM Best outlines the steps that life annuity insurers have taken to de-risk portfolios. I'm John Weber for AM Best TV. Joining us today to discuss those findings are Associate Director Jason Hopper and Financial Analyst Igor Bass. And Jason, let's start with you. So the analytical look here split this life annuity sector into separate parts: interest-sensitive companies versus non-interest-sensitive companies. Can you detail some of the differences between these two groups?
Sure, John. So the ultimate goal here was to see how strategies diverged in terms of investment strategies, and in combination with reacting to changes that they've made on the product side, whether it be lowering crediting rates or things of that nature. So we split, as you said, the insurance industry into two camps based on product profile. One was interest-sensitive companies, which primarily are individual or group annuity writers, deposit-type contracts, or interest-sensitive life products as defined by the NAIC. So we split these companies based on a reserve and premium mix. And we found that there are twice as many non-interest sensitive companies as interest sensitive. But on the flip side, interest sensitive companies command about 3/4 of the total industry's assets.
Igor, how much do the operating results and performances vary between the two?
John, that's an interesting question where results could significantly vary between the two. Interest-sensitive companies represent a quarter of the portion of the companies, but typically generate the majority of the earnings. The pre-tax and net operating earnings have been consistent for the most part for the interest-sensitive companies, but more fluctuation among the interest-sensitive companies over the last 10 years, but still remaining fairly positive. Also wanted to mention the yields have been fairly declining over the last couple of years, more so for interest-sensitive companies than for non-interest companies. And the interest-sensitive companies have a tendency to reach for the higher yield, and that's why have more risk involved in their portfolios.
Now, from a life annuity product standpoint, Igor, what moves are insurers making to de-risk?
Sure. Some of the moves that insurers are making to de-risk are cutting back on some of the certain products. For example, UL with secondary guarantees. They're curbing certain sales of new VAs with living benefits. They are favoring fixed index annuities and index universal life products that have lower guaranteed minimum interest rates. They're also trying to lower guaranteed minimum interest rates in their portfolios, as well as divesting in-force legacy annuity blocks and raising some of the rider fees, basically trying to get rid of some of the richness of the benefits. They're also trying to promote the new products like the registered index-linked annuity, variable annuity, which shares some of the downside with higher risk with the policyholder. So they're trying to do different things, especially trying to de-risk their portfolio with the richness of the benefits and basically getting rid of the secondary guarantees in the portfolios.
Jason, what are you seeing on the investment allocation side?
All right, so building on everything that Igor had just said, interest-sensitive companies have a larger need to maintain yields and limit spread compression based on their interest-sensitive business. So knowing that allocations do differ between these two sets of companies based on product profiles and their matching asset liability management. So one thing that we have seen across the industry is the move down the credit scale. We've seen NAIC 2 bonds becoming increasing share of the overall bond portfolio. However, interest-sensitive companies have nearly 1.5 times the exposure to NAIC 2 bonds as non-interest sensitive companies, roughly about 36% of invested assets. This is becoming a little bit more of a concern now in the face of COVID, as there may be more fallen angels than the financial crisis as this pandemic continues to move on. And with that, as bonds continue to continue to get downgraded, insurers are going to start facing higher capital charges. Another investment class that we've seen an increase in is private placements. Interest-sensitive companies have double the exposure as non-interest-sensitive companies, and we have seen widespread growth among this asset class, as nearly 3/4 of interest-sensitive companies invest in private placements versus less than 48% for non-interest-sensitive companies.
Now, the report also notes that while commercial mortgages remain a key investment strategy, there's been a bit of a shift in the quality due in part to COVID-19. So, Jason, what did your analysis show in that regard?
Historical performance has been great for commercial mortgages throughout the insurance industry. Yields have been declining, but they are still greater than bonds. So it is still a favorable asset class from that perspective. As you mentioned, John, quality is deteriorating, more so from CM1 down to CM2. But we've noticed that these efforts are more to increase yield as opposed to deteriorating conditions so far. That may change in the coming months due to COVID, as the stay-at-home orders and whatnot, just the lack of economic activity could affect the operating income at the underlying properties, specifically hotels and retail type properties. This could lead to declining valuations and higher loan to values.
Thanks, Jason. Thanks, Igor.
Thanks, John.
Thank you, John.
Was Associate Director Jason Hopper and Financial Analyst Igor Bass. You can find the full report online at ambest.com. For AM Best TV, I'm John Weber.